All right, everyone. What's up? What's going on? It's been an absolutely crazy week, and could the printer be coming, right? As this very funny meme here of Jon Snow with Jerome Powell's face on it saying the printer is coming. Maybe things aren't as bearish as they seem, and there's perhaps some hope, right? Now, Charles Schwab's trading platform, along with many others, were down on Monday. This was very frustrating for a lot of people, um, and we'll talk about that. It was really frustrating for me. I pretty much just took almost the whole day off on Monday because of it. But lots of headlines, okay? But here we've got Christopher Goodney talking about how we had a crash that occurred in one day, and the implication was that we were in or about to fall in a recession, and that didn't happen at all. So Ed Yardani is, pretty bullish about this right now. We'll talk about the real-time SOM rule indicator. I kind of covered it in my last video, but we'll go over how Barry Ritholtz, isn't so pessimistic just because of the SOM rule indicator. They actually spoke to Claudia SOM on the podcast. That was a really good video. And we'll just try and kind of talk about, what we've been doing, right? I mean, we talked about this rotation January 11th, right? A big showcase of rotation. We went ahead and went over a post showing how all of the major areas in the market, the most important heavy-weighted places, they all hit their targets, right? And how does it make sense for it to be a healthy place for it to start pulling back? Yeah, it did. So we got out of a lot of tech and we started rotating into other place, right? We had Carnival Cruise Lines did really good. Home Depot did really good. Caterpillar did really good. And of course, TLT, if you guys are fans of the channel, you guys know I love trading TLT. And these are some of those charts now updated, right? Hit price targets starting to roll over, hit price targets started to roll over. We'll break down all of these. There's going to be some really good info in today's video. All right, these are just going to be a preview of all of the different slide decks that we're looking at and how they affected the market, okay? Because we know a lot of the big headlines, but how can you be proactive to some of the data and get ahead of some of these headlines before they come out? Well, there's a lot of ways to do that, and going through the market internals, the different intermarket relationships, and different things like that will really give you a big clue as to when potentially things are about to turn in the market. We've got the risk on, risk off ETF right here. We'll talk about seasonality as well. And then we'll go over some more metrics like the Skew Index, right? Where we were at in the Skew, and how, TLT and copper, how those two are related. Dr. Copper, as they call it, often can give you lots of insights into the economy. And then we'll talk about the value line geometric index and where it's at right now. And then, of course, we got to talk about the massive spike in volatility that we had, and we'll go over the percentage of stocks above their moving averages. We'll take a look at some different ratio charts here, smart money versus dumb money, the relationship between bonds and stock market. And then we'll take a look at this ratio chart here of TLT versus the stock market. And then we had some warning signs in the McClellans and the put to call ratio, the Mag 7 breakdown, but relative to the equal weight is actually holding up very well. And then here, we could see a breakdown in many of our different ratio charts here, measuring whether or not the market is offensive versus defensive. We'll talk about the transports, what's going on there, and then the gasoline fund and how you can use this in line with inflation expectations. And just some more metrics, right? It's going to be a really great video. But as always, the content provided on this channel is for informational and educational purposes only and is not intended to be relied upon as legal, financial, or investment advice. So be sure to read through the disclaimer. Now, if you're new to the channel, I started a completely free newsletter for you guys. It's called Investment Intelligence, and I give out free, valuable content, and I also try to sprinkle in some free trade ideas in there for you guys as well. Okay, this is what it looks like on the website. You can go into the website and click on some of the previous articles that were published and written. So it's kind of like a blog format as well, and check it out and see if it's something that you guys would like sent directly to your inbox. Now, you can get into the Investment Intelligence private trading group using promo code SUMMER for just $1 for your first month. I forgot to do a 4th of July sale in July, so I pretty much just am doing a late sale for you guys. And this will last throughout summer. In there, you get lots of really amazing things. Okay, you get 20 plus swing trade ideas weekly. You get custom scripts and indicators, exclusive intel, and exclusive chart layouts. A lot of these chart layouts that we're looking at in today's video, these are chart layouts that are available to all the Discord members. Okay, so you can join the Discord, get those chart layouts. and all the hard work's done for you. And now you will just be able to quickly browse through and monitor these and see how the, mechanics of the market are working behind the scenes. Now, the printer is coming, okay? And this just suggests that the Fed is going to start stimulating the economy, whether it's via interest rate cuts or whether it's via injecting liquidity back into the market, such as quantitative easing. That's what we'll see. Now, we talked about Schwab being down. I was in the fortunate position where I had pretty much taken a lot of profits on Friday or closed a lot of positions on Friday. And on Monday, the bond market, TLT specifically, skyrocketed, right? And I was not able to close those positions for really large profits. So that's kind of why I was frustrated. Not so much that I wanted to panic sell into everything, but rather that I had some plays that were actually doing nice. I wanted to get out of those. Now, Ed Yardani, he's really good. Okay, you can check out Yardani research. He's got a lot of great stuff, but he's saying how today's financial panic, talking about Monday, looks like the stock market crashed in 1987 when the economy avoided a recession. Okay, when we actually avoided one. So we'll see if that'll happen. The Sum rule is saying that a recession is coming, right? But Barry Ritholtz, um, he talked to Claudia Saw, right, who's the inventor of the rule, has said that she doesn't think the current measure is indicating a recession yet. The Sahm rule is likely overstating the labor market's weakening due to unusual shifts in labor supply caused by the pandemic and immigration. So essentially, what she's saying there is when the pandemic happened, there was no immigration, right? Immigration was basically halted. And then now we've got lots of immigration, and the SOM rule is based on a moving average. Okay, so that's going to skew the data and mess a lot of the things up. And she's saying that she doesn't think the current measure is indicating a recession yet. That's the person who came up with the SOM rule. So while everyone you're reading on Twitter that just found out about the SOM rule, stating that it's the end of the world, the actual person who invented it doesn't think that it may, it could potentially not lead to a recession this time, and it could be the first time that it has not led to a recession. Okay, now as I mentioned, in the Discord, I went over and I said, hey, let's ask ourselves some questions, right? On July 11th, talking about the big rotation, where you could see that the Magnificent Seven, semiconductors, tech, and communication stocks were the largest stocks to the downside on July 11th. I told everyone that is a big showcase of rotation. Take a look at the daily performance of each sector, and you will see the big losers are basically all big tech today. So let's ask ourselves some questions. Is this a logical place to see tech, the Mag 7 stocks, and semiconductors see some rotation out? Profit taking, yes. Does this mean they can't go higher or that they have to dump? No. Price will tell us in the future. But the time to go aggressive and heavy into tech positions was in the February or April pullbacks that we had, or most recently in June, ahead of the bullish data that I posted and went over in the previous videos. So, giving everyone a warning, right? And I haven't really been going heavy into any tech stocks really since the middle of July. And here's that updated chart, right? We see they all rolled over, right? The S&P 500 hit its Fibonacci target, rolled over. The NASDAQ 100 hit its Fibonacci target and rolled over. Semiconductors relative to the S&P 500 hit their Fibonacci target, rolled over, and then semiconductors themselves hit their Fibonacci target and rolled over. Right, and that's this chart here that I was posting to the members in the Discord. Again, this is one of those chart layouts that you guys can get. This is another one, okay? And this is the equal weight versus market cap weighted S&P 500. Right, and then we have the delta, the S&P 500 equal weight rolling 8-day versus the S&P 500 rolling 8-day performance. Okay, so the equal weight versus the market cap weighted. And you see, whenever we get these massive spikes right here, that's typically when you start to see the equal weight outperforming the market cap weighted. Now, what does this mean, right? Well, typically that's in an environment where people are being a little more defensive, where you're starting to see big tech roll over. And that's a reason why the equal weight would be outperforming the market cap weighted. And we saw that signal trigger here very, very recently. Okay. Last time it triggered over here, and you can see that we had that outperformance in the equal weight, being that this is a ratio chart. Okay. The RSP, the equal weight, is the numerator. So if this line is going up, it means that the equal weight is outperforming the market cap weighted. We see that it broke out here recently, right? We see that breakout in the trend. You've also got the high-low index here. Okay. Now, I use this one typically to spot what's called divergences. Okay, so here we have the S&P 500 in an uptrend, and then we've got the high-low index here in a downtrend. So by using these, divergences, they can give you clues to the market. Okay, now sometimes these divergences last for longer periods of time. Sometimes they're much shorter, right? If we take a look here, we had this divergence where the high-low index was making lower high, right? And then, or I'm sorry, we had a low here, and then we had a higher low. Here we had a low, then we had a lower low in the S&P 500. So while we saw the market making lower lows, the high-low index was actually making lower highs, or I'm sorry, higher lows. All right, so just think about that for a second. All right, so you have the actual market in an uptrend, okay, stocks going higher and higher. But when you take a look at the, stocks in the market, right, in the New York Stock Exchange, and you see that you have, stocks, that are making more highs, and then now they're making more lows as the market is going higher. Does that make a lot of sense, right? No, it doesn't necessarily make a lot of sense. And so the same thing here, right, where you have the number of stocks making more highs now, we've got more stocks making more highs, but the stock market's going down. Does that make a lot of sense? No, right? And these divergences are pretty important. And most recently, we had a divergence, right? Where we had a high, we had a lower high, then we had a high, and we had a higher high. So the stock market was making more highs, all right, going higher. Meanwhile, the number of stocks and the stocks in the market were actually making less highs. That's a divergence, and it ended up leading to a rollover here in the market. So let's go ahead and move on to the next chart now, okay? And what we're doing is just we're using this info to help potentially give us an edge in the market, right? Okay, so if you saw this divergence here, then hey, maybe it's not the best time to be going super aggressive into the market right now, right? Even if you just saw that chart that I posted in the beginning, this one over here, when all of these things are hitting bullish price targets, do you want to go super aggressive right there? Maybe not, right? Maybe that's not the time to be going super overly aggressive. Now, if you didn't know, agriculture and bonds move in opposite directions. Okay, this is a monthly chart right here, going back about 20 years. So this is a 20-year relationship. This isn't something that just happened recently. Okay. And so we're using this, we're seeing that as agriculture was in a strong downtrend, bonds were in a strong uptrend. And then as agriculture started breaking out and getting into an uptrend, we see that bonds rolled over into a downtrend. Now, this is a yearly chart. Okay. So this is more recent. And I'm using this as an edge for TLT now, okay? And so I want to see, hey, this uptrend that we're seeing in TLT, is it justified, right? Has it been justified by the move in agriculture? And we see that agriculture is making these lower highs here as bond market TLT is making these higher highs. And so if we saw that agriculture was breaking out at the same time that TLT was breaking out, well, then that may be a little bit of a warning sign that, hey, maybe that was a head fake in TLT, maybe it's a head fake in agriculture, and maybe I need to just monitor that relationship and see which one is giving us a head fake. But for now, things have been moving clear, and the path has been clear, and this relationship has continued to maintain, and it's something that's just helped given me confidence in my TLT trade. Now, this is a risk-on ETF up here, comprised of copper, high-yield bonds, the Aussie dollar, semiconductors, and high beta stocks. You can see this clearly rolled over, right, taking out some previous highs. Meanwhile, the risk-off ETF was continuing to stair-step higher, right? Maybe it's not super aggressive to the upside, but we're still holding above previous highs, and we're still moving higher. The risk-off ETF being comprised of gold, U.S. Treasury bonds, the yen, utility, and staples. Now, this is S&P 500 seasonality, and take a look at this seasonal period here coming up. I think that this is very important for us to monitor. This is basically into the end of October. And why am I mentioning that? Well, because we have an election this year. Okay, so markets don't like uncertainty. We know that, right? Markets like certainty. They like being able to, forecast based on different policies and things like that. So whenever there is uncertainty in the market, markets tend to sell off, right? And it's very common for us to sell off into this period here. heading into an election cycle. Now, does that mean that there's not going to be trade opportunities, right? That the market's not going to go up, right? We see periods where it trends up, but ultimately it puts in highs, and lower highs. That's something that I think may happen heading into the election season, okay? And as we get closer to the election. But once the election is over, typically what we end up seeing is the market tends to bottom around that time after the election's decided. The market now knows what policies are going to be in place, and then they can go ahead and reinvest their capital that's been sitting on the sidelines. And typically you see a strong move heading into the end of the year. So keep that in mind, okay? And I think seasonality is something that a lot of people are underutilizing or perhaps utilizing in the wrong way. It's not something that you want to live or die by, but rather something that you want to have as a rough outline, okay? And just kind of know that, hey, maybe the next couple months heading into October and as we get closer to the election, maybe those aren't going to be the strongest times to be looking for outperformance and looking for massive gains, but rather maybe that's a good time for you to start looking at names, high quality names that you guys want to add to your portfolio and start determining some risk levels, some prices that you're okay paying for, knowing that it may not be the best entry and they could potentially head lower until the market finds a bottom. Now, this is the skew index here, okay? And the skew index, now the skew index, it offers some really, really great buying opportunities whenever they present themselves, which is going to be this zone down here, right around 110 to 115, roughly. Okay, I've marked all of those each times that we've come down into that zone. And you can see those have been great buying spots for the long term and even a little bit of a shorter term. But these yellow lines up here, these are areas where the market is typically too complacent, right? Not really much fear in the market, not much hedging going on in the market. And whenever these are elevated to these levels, it's very common for us to start seeing some pullbacks, right? You see, we hit up here, we get a pullback in the market here. Okay. When we hit up here, we ended up getting a pullback. And we've been hovering in this zone, in this elevated zone over here for quite a while. And you can see when we came up in here into this zone, right around this 155 area, that was right around our last correction that we had in the market. And then most recently, we've been back hovering in this zone and we're starting to see a rollover. So I use this basically whenever the skew is above 145 and touching some of these other levels here, I know that, hey, the market could be getting a little too complacent, right? Are there any other warning signs that I should be looking for, such as that high-low index, such as the equal weight versus, market cap weighted, and some of the other things that we're about to go over. This is another really good one right here. This is TLT and copper futures. All right. These two have been moving. We're in a divergent period here. Okay. And so we saw that copper was just rallying really, really hard, right? Everybody remembers when copper made this huge explosive move here, and it was moving opposite of bonds. And so we're wondering which one of these is lying right now, okay? Because they kind of move similarly, beforehand. And then here we see that copper rolled over and TLT started to make some new highs here. Now, the important thing about this is sometimes copper is often referred to as Dr. Copper. Okay. And you're going to see Dr. Copper. All right. You might hear that a little bit more, but what we saw here was a massive rollover. Okay. And the reason they call it Dr. Copper is because it's often used as an, economic indicator, right? In the strength of the, US economy. And seeing this roll over right here is not really a great sign. And if you think about it, seeing bonds go up, right? In my opinion, we're back in the period now where bad news is now bad news again, right? No more stock market rallies because of a bad labor market, right? I think that time is done and we're officially back into bad news is bad news. And if you think about it, treasury bonds, they're going to go higher whenever the outlook on the economy doesn't look good. Okay, and the reason for that is because treasury yields are going to start dropping. So yields typically will go down on weak economic data, because of the fact that it's pricing in maybe a little bit more of a recession or economic fears. Okay, when treasury yields go up, that's typically when you're seeing strong economic data and the market's going higher because on economic strength rather. Okay. And so, this is a little worrisome, right? We're continuing to see copper roll over as bonds are going higher. As economic data is weakening, we're starting to see bonds move higher. That's typically how bonds have worked. Not so much in the past couple of years, because everything's been so focused on Jerome Powell and the Fed rate hikes. Now, this is the value line geometric index. This is essentially all stocks, right? Or what is the average stock doing? And the market doesn't look like we're on the verge of a huge collapse. Okay. That's basically all I wanted to show here. This one has a nice little setup. And let's get into volatility. All right. We have volatility here. And so lastly, we've got the VIX, okay, and volatility, right? That's what this chart layout is going to measure. What I want to show you guys here is we've got these levels on the VVIX and the VIX. Okay, we've marked the times where the market has come to these levels, and it's often, shown and signaled, potentially bottoms, and also, when we're going to start some downtrends in the market. Okay. We have over here the last time the VIX came up to around 39, was right over here. It sparked a short-term bottom. We saw a little bit of a relief, a little bit of a recovery and sideways consolidation, but we did end up heading lower, right? And continuing to head lower in the stock market. And the reason I have the VVIX on here is, the VIX has changed in the way that it runs and it operates over the years as the market has changed. There's now these zero DTE options. All right. And there's stocks there's many different instruments, right, that are traded 24/7 now, and different things like that. And so I really like to monitor the VVIX more often necessarily than I do the VIX, because it moves quicker. The VVIX is the volatility of the volatility index, right? So it's the VIX of the VIX essentially. And this one will move quicker, right? You'll start to see, your levels, right? So you got your key levels down here, which are right around 16 to 13 on the VIX. And once it starts getting above 16, that's when I start getting a little bit, start paying a little more attention to the VIX. Well, the VVIX, weeks ago was already above its level of 83, right? So that had me watching volatility and paying attention to the VIX now, because the VVIX was already moving higher, right? And then it continued to climb higher. And, look at where it came to, right? It came right up to our key level up here, right around 173. So that's just a little bit of insight is, you can monitor the VIX, okay, but the VVIX will really give you some clues, and it'll start giving you a kind of a lead time into the VIX, right? And you'll start to see the VVIX roll over before the VIX does. You'll start to see the VVIX spike before the VVIX. And if you monitor that and chart up your levels on that, then it'll kind of let you know when you really need to start paying attention to the VIX. Because sometimes if you're just monitoring the VIX every day and you're in these really stale market environments, you're not going to see that huge volatility spike or perhaps an incoming volatility spike by simply just monitoring the VIX until it's too late, right? Now, we've got the percentage of stocks above their 200-day moving average here and their 50-day moving average here. All right. I use this also for divergences. This is a really good signal right here. And let's talk about why, right? So we've got the stock market going higher right here, right? Making highs, lows, higher lows. But somehow when you're in that uptrend, we've got the percentage of stocks above their 200-day moving average rolling over, right? And making lower highs. That doesn't make much sense to me, right? How are we in an uptrend, but the number of stocks, the percentage of stocks above their 200-day moving average is going down, right? Same thing with the stocks above their 50-day moving average. Okay, here we're in a strong uptrend, right? Highs, higher highs, higher highs, higher highs, lows, higher lows, higher lows, higher lows. But somehow the number of stocks above their 50-day moving average is in a downtrend. And we have got highs and lower highs here. That's a warning sign, okay? That's a divergence, and you see it led to a sell-off period over here. Most recently, what did we have again? Well, we had that divergence, right? Where we had, the highs right over here. Let me put my drawing tool back on. All right, so we had the highs, we had the higher highs, we have highs, lower highs, we have highs, we have lower highs. So again, the stock market was going higher here, but the number of stocks above their 200-day and their 50-day moving averages was actually going down. That's a bearish divergence. That's a signal that, hey, underneath the hood of the market, we actually have more stocks are performing worse. Okay, is what that's telling you. So even though the overall index is climbing higher and the overall stock market is climbing higher, the stocks beneath the surface, right? When you actually take a look, those stocks are performing worse. And it's just that simple. And, if you just think from a common sense perspective, well, is there anything I should be worried about? Well, the stock market keeps going higher, but the stocks in the stock market are actually performing worse. Maybe that's a warning sign, a signal, and that's why I like to use these divergences in these charts. You can also chart it up for the extremes, whenever you've got 90% of stocks above their 200-day, 90% of stocks above their 50-day moving average. That's telling you that, hey, these stocks really can't perform any much better, right? I mean, think about that too from a logical perspective, right? How much better can it get than 90 something percent of all stocks trading in an uptrend, right? And so whenever you get to those frothy levels, right, then it's time to say, hey, well, maybe this isn't the best time to add because everything's performing so well that if you think about it, where can we head next? What's a logical place? Is it going to be 100% of all stocks performing above their moving averages, or perhaps is that going to start to decline, right? That's the way that I like to use these type of indicators and chart layouts. Now here we've got some different measurements, right? We already talked about the equal weight versus the market cap weighted S&P, but when you take a look at small caps versus large caps, we did have this large, massive outperformance here in small caps recently, and everyone was super excited about small caps, and then that completely rolled over. Meanwhile, industrials versus tech is still in a very nice uptrend here as of recently, right? Obviously, it's been in a downtrend for most of the year, and not so much due to industrials being bad stocks, but rather tech has just been so strong, right? And really been carrying that AI narrative, really carrying much of the gains in the market. But here we're seeing that change, right? And we're seeing industrials relative to tech really outperforming here. And, this is just a sign to say, hey, well, we've already taken a look at many of these things and seen that, hey, maybe it's not the best time to be adding to tech. And that's why we started looking at some names like Caterpillar, right? That's why we started looking at some names like Home Depot and mentioning, healthcare stocks a lot too, transportation stocks a lot too. If you guys are signed up for that newsletter, you know that, the past week or two of stocks that we've put out and trade ideas and things that we've been mentioning, they haven't really been big tech focused, right? But a lot of them have performed really well. CHRW, the call options on those went up like 300%. We had CHTR. That was another one that had a really good trade. UNH did really good, right? We talked about the healthcare sector, UNH, the inverse head and shoulders, the breakout there. There's been other areas of the market that have been performing well. Now, we've got smart money versus dumb money here. Okay, now I didn't come up with these names. Now, smart money is, they refer to the HYG, which is your high yield ETF, as smart money. And you can see smart money had a blow off top here, while the dumb money, the S&P 500, was continuing to just make higher highs this entire period. Smart money was stuck moving sideways the entire time. It had a false breakout to the upside. False moves often lead to fast moves, and you see it rolled over here and started dropping, and dumb money ended up following along with that as well. So this was just another one of, those divergences in the market where typically you want to see these two things moving very similarly, right? You see we have a small downtrend, uptrend here, small downtrend, uptrend, then we roll over, make new lows, roll over, make new lows. They bottom out right around the same period, start to rally, and then here is really where they went through this divergence period throughout all of 2024. Now, bonds and the stock market. Okay, now these tend to move similarly, all right, and they have been moving similarly over the past 3 years. But now we're back in this period here where bonds are going up and stocks are going down. You may have heard of something called a 60-40 portfolio, where 60% stocks, 40% bonds. And the reason that people constructed this type of portfolio was that so the portfolio was hedged, right? In case of the stock market rolling over, you had that bond market percentage of your portfolio to help cushion some of the losses to the downside. And again, this really just implements that we're back in a period where bad news is bad news and good news is good news. So I think that that will continue to be the trend in the market moving forward, is that, the market's not going to keep rallying on bad unemployment reports. The market's not going to keep rallying on, terrible inflation reports or anything like that. I just think that that's where we're at right now. We've got some more economic data coming in the future. We'll see if that continues to be the trend for the rest of the year and moving forward. But that's something that I really think is a possibility. And I think that that's where we're at in the market. Now, we have this period here where bonds were trying to get into this outperformance period of the stock market. This rolled over here more recently as the stock market has rebounded and bonds have started to pull back and digest some of their recent gains. But that's another thing to monitor. And what are some more signals, right? Well, you have the McClellans. You have the McClellan Summation Index, and you have the McClellan Oscillator. And again, I like to use these for divergent periods. Okay, so see the S&P 500 making higher highs. We see the McClellan Summation Index making lower highs, as well as the McClellan Oscillator making lower highs. And that ended up leading to a sell-off here in the stock market. Now, during this sell-off here in the stock market, we ended up creating a bullish divergence, right? Where we had a low, and then we had a lower low right over here, and then we had a low, and we had higher lows over here. So this was a signal that, hey, maybe this sell-off, while it was justified and perhaps forecasted by something like the McClellans, maybe now it's getting over-exaggerated and overdone, and we're actually starting to see market breadth improve, okay? The McClellans are market breadth instruments. So you hear people talking about that a lot. What's one way to measure it? Well, you can use the McClellans. And here we had this bullish divergence in this time period here. And you see that ended up marking the bottom. And then again, most recently, we had a bearish divergence in the McClellan Summation Index and also in the McClellan Oscillator, while the S&P 500 was continuing to make these highs. And you see we ended up rolling over there. So the whole point of this video is to give you guys the tools and resources available to your disposal that the average person can use, right? I'm not anybody fancy. I'm not on Wall Street. I'm not working for some big, large firm. These are just things that I've learned over the year on how to use. What are some of the tools and resources that, big money in Wall Street and all these people use? And a lot of them are here in this video for you guys. So, you can take screenshots of all these different charts. You can join the Discord and gain access to these different chart layouts, or you can purchase the chart layouts yourself if you don't want to do the hard work and make all of these charts yourself. Okay, here's another one, the put call ratio. And so green is basically when you're in bullish territory, red is when you're in bearish territory. And look at how low the put call ratio got. Okay, now some people may use these as a contrarian signal, right? Whenever we're up here in this bearish territory and things are extremely bearish via the put call ratio, sometimes people look at that and say, maybe this is a buy signal, right? People are too bearish. And just like over here, when we're too bullish, okay, and the market is too bullish and we see the put call ratio is extremely low right here, a contrarian may say, well, we're way too bullish right now. Perhaps I'm going to short the market or start selling some of my positions. And you can see that pretty much marked the top almost most recently in the NASDAQ. Now you've also got the Magnificent Seven index right here, ETF MAGS. It formed this head and shoulders pattern right here. You see we broke through that neckline, had a very strong move to the downside. And again, meanwhile, the equal weight S&P 500 was holding up much better, right? And really, the Mag 7 Index ETF, it topped out here in early March. Okay, maybe late February, early March, and started going into a downtrend. Meanwhile, the equal weight was just continuing to climb higher here. Now, this is another chart right here of that I really like a lot. So you've got the stock market here, and then we've got a ratio chart of high beta versus low volatility stocks. And I really, really wanted to see this breakout, guys, to signal more strength in the market and that we can have another leg up. But this thing just rolled over. So, here we're in an uptrend. We're in a downtrend now in high beta versus low volatility. We're in a downtrend in discretionary versus staples. And we're in a downtrend in credit spreads. So really justifying a lot of this rollover that we've seen in the market. Surprisingly, biotech has been holding up. And I've heard people say sometimes that, in these big times of uncertainty or tech crashes and things like that, that biotech, pharmaceuticals, healthcare stocks can often be, a flight to safety and somewhere where people put some of their cash in. And this chart kind of shows that, right? It's been holding up relatively well, considering, the massive moves that we saw into the downside in the market. Now, transports, if you pay attention to the Dow theory, essentially what it says is that, it's based on an economic outlook, and, what you're looking for is, if the economy is doing good, industrial stocks should be doing well. And if industrial stocks and the economy is doing well, then the companies that transport, all of those goods and services should be doing good as well. And that's going to be your DJT, okay? Not Donald Trump stock, but rather the Dow Jones Transportation Index. And this one here, guys, has just not caught up, right? It peaked, and oftentimes it gives signals to the market, right? So it peaked before the industrials peaked in the last bear market, and before the stock market peaked in the last bear market. It also bottomed before the stock market bottomed in the last bear market, at the bottom of the bear market. So it peaked before the other stocks did, and it bottomed before the other stocks did. And while we've seen industrials show lots of strength and continue to make new all-time highs, as well as the S&P 500, the Dow transports simply just have not. So I think heading into the back half of this year, you really want to pay a lot of attention to the transports. Can the transports finally catch up to the rest of the market? If not, if they continue to roll over, that could be another warning sign that, beneath the surface, the market's telling you that the economy isn't really as strong as maybe the major indices are pricing in right now. We'll move forward to the next one here. We'll talk about the gasoline fund, UGA, and inflation expectations. This is something that you can use for inflation expectations. Specifically, I use it kind of to trade TLT. And we had this period here where inflation expectations were breaking out, right? A little bit of an oops right here. And when you look at the gasoline fund, it didn't do the same thing, right? It peaked highs just like this peaked highs. And we actually came in here and made a lower high. So when this was breaking out, essentially we had a divergence here, right? Where we had this making an uptrend, this making a downtrend, and ultimately UGA ended up being the signal that inflation expectations were going to start rolling over. As inflation expectations were rolling over, that was a bullish sign for TLT. And that's basically how I use that chart. Now we've got growth versus value here measured via small caps and the S&P 500. And we saw we had this great breakout, right? The S&P 500 growth versus value was really stuck moving sideways for pretty much the entire year up until May. And we saw a very strong breakout. And now we've seen an aggressive rollover back down to the downside. Same thing here with the Russell 2000, right? We had a strong breakout and we're back at those same levels that we were just at in the Russell 2000 growth versus. So yeah, you really want to see improvement in the growth versus value ratios. What's the reason for that? Well, typically in bullish market cycles, you will see growth outperforming value, right? I mean, let's just take a quick look at that. If we take a look over here, what do we see? The S&P 500 in a downtrend, and we see growth underperforming value, right? Remember, growth is the numerator here. So if this chart is going down, this means that growth is underperforming value, right? And we're in a downtrend in the overall market. Then, we take a look at this uptrend that we had here in growth versus value. And what's the stock market doing? The stock market's in a nice uptrend, okay? So we really want to see improvement in the growth versus value ratios, whether it's in small caps, whether it's in large caps. And then the dollar, okay? The dollar is also another really good thing to use as a signal. It's not a coincidence that the dollar peaked the same time that the stock market bottomed. Again, not a coincidence there. Now, these two typically have an inverse relationship, as you can see by these black lines, where the stock market, okay, is going down typically as the dollar is going up, and the stock market is going up as the dollar is typically going down. Now, you do have these periods where you get these divergences in the chart, okay? So they're already naturally inverse. So when they're not doing what they normally do, that's what we would call a divergence, okay? And here we had a 4-month divergence where we saw the dollar going up as the stock market was going up. So we had that divergence period. Last time it led to a rug pull, right? And we saw the stock market continue to sell off. Again, here recently, heading into the year, right? So this is the beginning of the year. And then heading into April, we had yet again another 4-month divergence where the stock market was going higher as the dollar was going higher. And, if you were watching my videos at that time, I was suggesting, hey, we could see quote unquote another rug pull. Now, was I predicting that we're going to head into the next bear market? No, nothing in the economic data in April suggested that we were going to have a recession in the next 6 months. Here we are 4 months later, almost 5 months later, and a lot of the data is starting to weaken in the economy. And so some of the recession fears are increasing in the market. And we've seen another pullback in the stock market. Okay. But if you're taking a look, they're kind of both pulling back right now. Okay, we've got this period where the dollar and the stock market are both kind of dropping at the same time. That probably won't last forever. And we'll see if the dollar and the stock market go back to their typical inverse relationship, where as the dollar goes higher, you see the stock market go lower. So be on the lookout for dollar strength. Okay, that could be a potential headwind for the stock market over the coming weeks and months. And that wraps up today's video. We went over a lot in today's video. I know it can seem like a lot, but these are all really good things to start learning. Okay, and I've made it very easy to learn these things by making these chart layouts accessible for all of the Discord members. Okay, so remember, you can get in there for just $1 right now using that promo code SUMMER. Get in the Discord, copy and paste the links for all of the chart layouts into your Thinkorswim platform and save them. And now you've got those chart layouts, and all you got to do is run through them. Okay. You don't have to do any fancy charting. You don't have to do Fibonacci's. You don't have to do all of these crazy things. You can just look at those charts and see what they're telling you. Okay. And I went over what you want to look for in those charts in today's video, and how they can give you an edge into the market, but tell you and tell you when potentially things are about to turn, whether it's turned to the upside via some bullish signals, or whether it's turned to the downside via some bearish signals. There's lots of ways that you can use this information. And inside the Discord, not only do you get those exclusive chart layouts, you get custom scripts and indicators, a couple of which we went over in the video. You get 20 plus swing trade ideas every single week. You get exclusive intel such as unusual options activity. There's dark pool levels. There's gamma levels. Much more via the stock bot inside of there. And if you don't want to pay for anything, okay, that's fine. I understand that. I'm doing my best to put out good information and good resources for you, such as the newsletter, right? That's completely free. In there, you gain, valuable insights. I put out, finance and trading related content, and I even sprinkle in free trade ideas in there for you guys. All right, you can check out the website if you don't want to sign up immediately and you want to read some of the previous articles and see what it's like, what you would be getting yourself into. And if it's something you enjoy or you think you would enjoy or appreciate, well, then you can sign up for that using the link in the description as well to get those sent directly to your email inbox. And if you ever want to do a coaching session, right, maybe a one-on-one session, you want to go over some of my day trading dynamics, my swing trading strategies, or you want to have an interactive Q&A, visit my Ko-Fi page, click on the commissions tab, and in there you can book a 30-minute or a 1-hour session directly. And they also have this really cool buy a coffee button, basically a way to leave a tip or donation for all the free valuable content that I put out via the YouTube videos, via the newsletter, and different things like that. So I really appreciate you guys watching. Don't forget to smash the like button, subscribe to the channel, and also share the channel, okay? Share the videos, help me get to 10K subscribers. I'm almost there. I'm right around the corner from 9K, and then we've only got 1,000 more to get to 10K subs.